Tuesday, and this is Vetted VA Live, where every week we get together with a group of vetted experts, both loan officers and real estate professionals, to answer your questions, go through a topic of something that's happening in the market, either mortgage or real estate, that you need to know and be aware of if you're out looking to buy, even sell, or finance a property right now. So this week we are heavy on the loan officers. We don't have any of our real estate pros with us. We're going to be talking about credit scores, what that means for your VA mortgage, and we're going to transition from there into the debts that show up on your credit report and your credit scores, and what that means in terms of a debt to income ratio and what's possible with a VA loan, which is probably the most flexible mortgage program out there debt to income wise. So we're going to walk through that, and these guys are going to tell you what that means for you when you're looking to get qualified. Before I introduce everyone, remember the most important thing that we do here every week is answer your questions. So if you have any question, mortgage and real estate related, doesn't have to be just credit and debt to income specific like we're covering tonight. So if you have a question, throw it over in the comments. We will absolutely get to all of the questions, get you the answers that you need. And if no one breaks the ice and asks a question soon, I'll keep reminding you guys through the show that we are definitely here to get you the answers that you need. So here on the top row with me, we got JD Matthew. JD is in San Diego. I'm in Orange County, California. We've got Mike Payne on the other side of the country in Tampa, Florida. And Rylan is kind of in the middle. I don't think Colorado qualifies as flyover country, but you're getting close to the flyover country, right?
Pretty close, yeah.
So let's just kind of start the discussion. I think it's important. People have some misconceptions around credit scores and what a good score is. There's always been this idea that if I can get to a 700, I've got a really good score. So we're going to talk in general, just in the general population, if you want to be around the water cooler at the office, what it takes to have the best score. But more importantly, we're going to talk about what it means in terms of mortgages, because mortgages are pretty darn lenient when you see how credit scores distribute. So according to the Ascent report, this is from March of 2020, so this may have changed a little bit, but 20% of Americans have a credit score between 800 and 850. That one kind of blew my mind. I don't think from my perspective, I see quite that many borrowers at that 800 level, but they're definitely out there. So 740 to 799 is the next 25%. So 45% of Americans have a score 740 or above. So if you're out there and you want bragging rights, you probably want to shoot for that 740 or higher. 670 to 739 is 21%. So that 680 to 720-ish range, which is where a lot of our borrowers follow, is kind of middle of the bell curve there. 18% fall into the 580 to 669 group, and 16% of Americans have a score 579 or lower. So when you look at it, the average FICO is 716. Now, in you guys' experience in dealing with borrowers every day and pulling credit reports, how do those numbers match up with what you're seeing? Rylan, is that pretty consistent with the reports that you're pulling on a daily basis?
So it's not consistent. The average being 716 is pretty consistent to me. I'll toss out there the 800 to 850 range and the 300 to 579 range. We probably never get to see those people. The 800 to 850 range might have more of a personal banking relationship or be buying cash stereotypically. And the 300 to 579 range might not be as eager to apply, which is a big part of why we have these conversations, educating people that VA loans can go down, VA and FHA can go down as low as 500 on FICO in some cases. So I think that I don't see those numbers quite as often because of maybe those instances, but otherwise, yeah, pretty accurate. 700, 716.
The other thing that always jumps out at me when you hear that scores can go much below, say, 450, I would say once every couple of years do I see a score in the fours. And I don't know about you guys' perspective, how often you see it or what it looks like, but it almost is someone that was aggressively trying to blow up their credit. Like looking at it, it almost appears as though you would have to try to take out a lot of debt and not pay it. So we talk a lot here on the show and with VA borrowers in general. VA doesn't have that minimum credit score. So we go to a 500. So occasionally we'll see those and actually help those borrowers, but much below 500 is pretty unique. JD, from that perspective, why don't you walk us through what VA's requirements are and then kind of how that translates into good rate, best rate type scenario?
So with the VA, since there's no minimum required score, what they want to see is that you've established or reestablished a positive credit history. So you've made all your payments on time in the last 12 months. That's the minimum to get you approved. Now, based on your credit score is when you see adjustments to what the rate is going to be. So for example, somebody with a 720 and above, or even 680 and above for some lenders, you'll get the best rates for a VA loan. And then it goes down from there. So then you have different levels, 620, 640. And one of the biggest changes I've noticed personally is 579 and below is where you have the biggest adjustment there on the rate.
What typically are you seeing? Because I think it's important for us to tell people, yeah, every week here, I get to talk to 1, 2, 3 other mortgage professionals, vetted VA, doing a lot of VA loans. And a lot of that business is being done. It's a unique situation, but quantify that. So like this is being streamed on YouTube.
Mhm.
There's a ton of YouTube videos out there that'll say VA mortgage, no minimum credit score. So people will call and say, hey, I got really bad credit, but it's VA, it's okay. What does it mean if someone rolls in with a 550 credit score relative to that veteran with the 720 credit score?
It means that I'll be paying more attention to the actual credit history, the line items. So I'll look at every single account to see if there's any late payments recently. And when I say recently, I mean the last 12 months. Sometimes, even if there is a late payment in the last 12 months, it will depend on the situation. So we will ask that the borrowers write a letter of explanation for every item that we call derogatory, every little mark on there to explain what happened. So, for example, I was in the hospital and I was not able to make that payment because I was going through some treatments. That's a potential reason where an underwriter could reasonably decide that you didn't decide to not make the payment. You were in a hardship situation and you legitimately could not make the payment. Now, if you had funds available and you decided to go to the club and then you couldn't make your car payment, that's a different story.
It's hard to go to the club and be in the hospital at the same time, though, JD. It's
Well, exactly. That's what I'm
mutually
saying.
exclusive.
And to our borrowers listening, or to potential buyers, I'm gonna put this out there. What JD just said, we're gonna ask you to explain what happened. An underwriter is gonna read that explanation. I've had a client just flat out say, "I didn't want to pay them." That's not a good reason, and you should be truthful, but maybe be tactful in your truth. So I'll just mention that to any potential buyers. An underwriter is going to review this, tug on their heartstrings as a human being.
And the thing that I like to explain to people, I don't get to write your story as a loan officer, but I'm the editor. I'm going to help you polish it and make it as pretty as possible. We're never going to break the truth and tell them something that isn't actual and factual, but there's 2 ways to tell the same story that presents you in as positive a light as possible so that the underwriter gets to the conclusion that we want. Now, last week on the show, we did go through a couple of unique scenarios where a veteran may be inclined to go with a conventional loan. Very rarely might consider an FHA loan if they were on the lower credit score spectrum. Mike, why don't you go through credit score wise what those loans look like in case we have any veterans watching tonight who may have a need. They've used up their entitlement. They need to go with a conventional loan. Any type of scenario where they may need to go that route.
So typically you're going to want your conventional loan, your minimum credit score is 620, but you're going to want to at least be 720 or higher, or you're going to end up paying a lot in a higher interest rate, which is higher than a VA loan. And with FHA, you can go down to 580, but typically you're going to want to be around that 680 credit score, sometimes down to 660 or 640. But you can go all the way down to about 580 on an FHA credit score.
So from that perspective, VA is probably the most flexible. FHA is close, but would you guys agree in terms of this? VA is probably the most flexible option that a veteran would have. And on top of that, the fact that even let's say you are that veteran that has a 550 credit score, you can be approved, whether it's a manual underwrite, which we'll talk about a little bit later on. You somehow have a lot of equity, you get an automated approval. You're not going to have mortgage insurance. And even that, high interest rate for the sub 580 borrower is still going to look pretty darn good relative to the other programs that we have out there. Why don't we kind of talk a little bit about, we talked about what scores are, what they need to be for the different loan programs, VA specifically, but for anyone watching that's saying, how am I going to maximize, or what goes into making up the credit score? When you're looking at a credit report, JD, and talking to a borrower, what's kind of the number one thing that you tell them is going to have the biggest impact on their score? And obviously, we're probably all going to say payment history is the big one. Make your payments on time, but people are sometimes surprised. I'll tell them, hey, you got a 672. Like, what are you talking about? I got perfect credit. I've never missed a payment. So why don't we kind of go deeper in the details, not the obvious one. If you miss payments, especially recent missed payments, that's going to ding your score pretty big. But beyond that, what are the big elements that are impacting credit scores?
Beyond that, you have credit utilization. So how much of your credit limit are you actually using? So if you have a $500 limit on a card and you're at $499 or above that, your credit score is going to reflect negatively. If you keep it below 30% utilization, so 150 or below for a $500 credit card, it's about neutral. And if you keep it at under 10%, usually have the best effect on your credit score. On top of that, they're also looking at how long you've had those credit accounts. So if I've had an account for 10 plus years, it shows that I've been responsible with my credit for that amount of time. And so the longevity also impacts the credit score itself.
So in terms of, Rylan, when you're looking at someone's credit, what are the big things that you advise them? Or actually, how often does that come up for you? Most times, are you looking at the credit and saying, here's your credit, here's what the terms are that you get? Or is this a situation, guys, where we're analyzing that and saying, hey, looks like you could pick up some points here and maybe hit that 640 threshold, or hit that 680, or hit the 740 and get to a better tier? What are the things you're looking at and advising your borrowers?
Absolutely. So a lot of our credit repositories where we pull credit reports from have added in little kind of hints at what the credit could get to. They don't go into a lot of detail, but I'll generally take a look at that. And if it's enough points to get them to a major credit tier, and like I said, it's different bank to bank, but like 680 is a big number, 720 is a big number, or 640 on the lower end, 580. If we can get them above those next tranches, then I can go and run something called Credit Expert or Wayfinder, and we can run scenarios to see what we get them there. And then we compare, all right, if you pay down this card $5,000, it's going to save you $3,000 or $5,000 in fees or interest rate points or whatever, right? And then we can help them compare, like, all right, well, you're going to spend the money one way or another. You might as well spend it on your own debt. And yeah, I do that pretty often with clients, actually. And, to JD's point, under 10% is the ideal utilization. But I also tell clients all the time, not using credit is actually counterintuitively bad for your credit score. You want to always leave a small balance, $5 even, and let it accrue interest and make on-time payments. The credit bureaus want to know that you are responsibly borrowing money. If you don't borrow money at all, it doesn't count any positive points towards your score, and over time it'll hurt. So something to keep in mind.
And I'm sure you guys get the one that I get all the time. Person says, well, why are you saying I have a credit card debt? I pay it off every month. And counterintuitively, like you said, if it truly hit a zero balance and it's scored with a zero balance, it's going to have a lower score. Mike, do you want to maybe explain to anyone watching here why, despite the fact that the person that does pay their credit card in full every month, when you pull it, we're likely to see a balance there?
Because when the credit reporting companies get their reports, they don't always get it on the same day that you paid for your credit card. So as you're charging stuff over the month, when the credit report company pulls that gets that report, it's not necessarily the day that you paid it. So that's why you rarely see zero. But there are some times where I have recommended to, especially veterans, with the veterans that I've seen, just just to even open a credit card. Sometimes veterans that I've worked with don't have any credit at all. They don't have any revolving credit. So I just say it's better to have an open credit card with a zero balance and not use it if you don't think you're responsible enough than to not. And that is helpful for some people that don't want to have credit cards and don't want to have that burden of worrying about paying for it. But still, it's not as good as using it, but it still increases your credit if you can have that credit card open and just not use it.
Do you have any advice for borrowers, veteran or non-veteran, or when they're trying to establish that credit, about how to use secured credit cards and maybe any pros or cons, or what they need to be doing if they're using that to establish credit?
I would say just buy groceries once a month and pay it off. Only use it for one item and pay that one item off. Don't use it for multiple things where you'll forget about it. If you're trying to build credit, use it as a tool to help you build that credit rather than using it as a tool to make your life easier. That's just what I've told people in the past.
And from our end, you can usually tell when it's a secured card. If I see a credit card with a $300 or a $500 limit, generally not a standard card. And like to your point there, if you put 2, 3, 4 bills on it, you can get that thing up to $250, $260, $270 pretty easily. And we go back, that's probably, without missing a payment, that's the number one thing you can do to whack your score, especially if you only have 1 or 2 of these $300 cards and they're both up at $220, $230. You can say, well, I've had it for 10 months. I've never missed a payment. Why is my score so low? That's one that I always want to caution people. We want to be using them, but when they have the lower limits, get a little bill, get Netflix or whatever, anything that you can get on there to just have it billing every month, but not charging it. We actually, guys, have a couple good questions here. So let's jump in here. First one is, what about soon to be retirees who don't have a job yet, but would like to purchase a home? So let me kind of throw out a hypothetical. So a hypothetical. It's a borrower that I talked to, they're selling in California, veteran moving to Colorado, and they're retiring right now. So in their situation, they 1 pension, 2 Social Security incomes, and a VA disability. So in that situation, we don't need anything here. So if you're still here and watching, maybe give a follow-up question. But what about this situation where if my borrowers needed income to qualify, what advice do we have for retirees who want to purchase but are looking for a job? Are there any options for them prior to getting the job and getting to work? And probably it would be similar advice or the same answer to someone just leaving the service. Would you guys agree?
Yeah, absolutely. So, right off the bat, if you do have any income as a soon-to-be retiree that we can prove, so if you're active duty, we can pull your retirement pay from a calculator online that's verifiable. Anything that's documentable and verifiable, we can use kind of if come in the future, your loan officer can work with you on that. There's many loan programs, VA is one of them, that allows job offer letters. And usually within 60 days of your first mortgage payment, as long as you are starting within 60 days of closing, which will also overlap typically your first mortgage payment, we can consider that job offer letter income. We need to know how much you're making, when you're starting, and that there's no contingencies that are going to jump up and surprise you and cause you not to be able to work that job last minute. But that's available. And in some cases, if you have savings set aside, we can even push that job offer letter date out if we can show the underwriter that you have assets to be able to carry the difference or the gap and be able to pay that mortgage in between the time you're retiring and starting the new job. So there's a lot of options for you there in that regard. In terms of our credit and the conversation we've been having so far, I'm just going to reinforce it. Make sure you're paying your bills on time when you retire. You're going to have extra free time. Maybe you're going to get out of your daily routine. Make sure your bills are on auto pay, or make sure you're hitting those payments, because even that small $35 credit card bill that you miss could potentially hurt you and cost you thousands on a difference in interest rate.
Speaking of auto pay, highly recommend setting up autopay for every single account because you never know when a snap deployment or underway is going to happen and you don't have access to the internet because of River City.
And it's funny. I'm a little older than you guys, but remember in the '90s, before we had the internet, and any of you guys watching at home who might be older than that, before you had that ability to set up the auto pay, I remember like waking up at 2 a.m. going, "Did I make that payment? Did I forget?" So it really is wonderful to have that peace of mind, and you can set it up just to make your minimum payment because what the reality of what happens is, let's say if there's $500-600 on there and you would normally pay it in full and you just make the $25 minimum payment, the late is the only thing that can't be fixed. You can go back 2 days, 5 days, 30 days later and pay that balance down to what it would normally be. But the late, there's no putting that genie back in the bottle. So I can't recommend the auto payment highly enough. I would go so far as say anyone watching this show, the number one thing you can take from it is get all of your cards on auto pay to at least make that minimum payment. This person actually had a little bit of follow-up. I'm not sure it really changes the answer here. Single, 750 credit score, no other debt, selling the other home, already under contract. So without the job, it's not going to change much. And then they also followed up, I do have savings, provided that to my lender as well. So it sounds like you might be working with a vetted VA pro because they've done all of the legwork here in terms of the things that you can and should be doing to help you get qualified without a job that you may be getting further down the line. So a couple of other good questions here. How about American Express balances when they have no credit limit? Any advice or thoughts on how the scoring model looks at it, and also how we are looking at it when the underwriter is going to review that?
So I don't know about the scoring model. I'll defer to someone else if they can share guidance on that. I've actually never thought of that, but that would be interesting as far as utilization ratios go. As far as how it affects your mortgage or your qualifying, so if I see what we call an open account or a charge account, which are typically paid in full every month, and Amex is really popular for this, we can do one of two things. I can do a 5% calculation on your total balance, and we can use that monthly payment in your qualifying ratios and residual. I can also show that you have enough assets in your bank account and hypothetically reduce your assets by that amount to pay the card in full. You don't actually have to pay it in full for us to omit that monthly payment, but we just need to show the underwriter you could at any time, and then we don't have to count that against you either. Those are probably two of the more popular actions I would take with a borrower whenever they have an open account.
And I don't know about you guys, but the only time I've ever really seen it be a problem is I've had borrowers that they have an American Express with no limit or a spectacularly high limit that they use for work, and it'll have a $28,000, $30,000, $40,000 balance on it, and they're like, "Oh, it gets paid off every month." We're like, "Cool, we need to show that you can pay it off." Like, well, I don't pay it off. My company pays it off. So most times, if it's a normal American Express that is revolving and doesn't show a payment, you know that it's going to need to be paid off and have accounted for the money, especially for the type of person who is going to be getting a mortgage and in the market to buy a home. So it rarely becomes a problem. So we got another question here. I'm not sure I'm following. Maybe you guys can get this. So the lender is saying they need our VA rating to help us qualify, but we don't know our rating until after retirement. Currently on terminal leave and need to provide proof of income. Any of our veterans here have the answer to this one?
Yeah, it seems like they're talking about VA compensation or disability rating. And so if I'm understanding this correctly, this veteran has applied for VA compensation, but don't know yet what their rating is going to be. If they're on terminal leave, they most likely will not have it unless they went through a military medical evaluation board process. And so it's a tough situation because you're between a rock and a hard place. If you need proof of income, it's unfortunately something that's going to have to wait until after you get your DD-214 and you're out, you submit it to the VA, and then they start finishing up the process for you.
And in your experience, what type of timeline are they generally looking at with that?
Usually at least 3 months. 3 to 6 months is ideal if they applied 6 months before separating. through the benefits delivery at discharge, if they went through, okay, they applied and waiting for ratings. But yes, with the benefits delivery at discharge, if you applied 6 months beforehand, you've already done all your exams, and all the VA is waiting for is that DD-214 so that they know this service member is out of the military now, and we can actually process the ratings finally. And then it just takes however long it takes for them to go through their backlog. It's better now. It used to be it takes a year or two.
That's definitely better than a year or two. A year or two doesn't sound like a fun wait when you're trying to get a mortgage. So we've actually got another question here from Shay, but it really falls under the debt to income stuff. So let's get through that and then we'll circle back. If you guys are watching, you have any questions, credit related, DTI related, anything mortgage and real estate related, we're happy to go through it. So just throw up your questions in the comments. We'll get to them. While we're waiting for a few more questions to come in, let's circle back here, kind of talk about what goes into that credit score. But there's a few things that I wanted to go through and still talk about. The big one that we get all the time is borrowers saying, "Ooh, I don't want to put my credit. It's going to be another inquiry." Mike, what do you say to a borrower who's worried about inquiries? Is it a real fear? Is it something that's overblown? And how important is it that you get the actual credit report with a hard pull when you're trying to pre-approve someone?
When you're trying to pre-approve, you really do want a hard pull, because that's how you actually tell. You can do a soft pull up front and it doesn't affect your credit, but you really want that hard pull in order to be able to get that actual pre-approval. The actual loan is going to require a hard pull, and to get a pre-approval, you want that hard pull. It doesn't really affect your credit too much unless you've been shopping for an automobile and had a whole bunch of other hard pulls on your credit. It's not really going to affect it more than 3 to 5 points. And if you had another mortgage company pull it within 90 days, it's not going to affect it at all because they know you're shopping around.
So let's on that subject talk about kind of somewhat different, but this can avoid a ton of headaches. Do you advise your clients to use opt-out pre-screen before you pull that credit report, and how do they benefit from it? Or I should say, what torment will fall upon their life if they don't do that prior to you pulling the credit?
I would rather pull their credit after I know that they've done opt-out pre-screen, because it's going to make their life easier and my life easier. I've had 2 people that said, "Oh yeah, we did it," and they didn't. And they got upwards of 40 to 70 calls and texts in a day. It is absolutely, if you're going to do it, just do it right now. If you're watching right now, just go right there and just sign up for it.
And you're like, if anyone watching thinks Mike's kidding about 40 to 70, I have it saved here somewhere. A borrower of mine sent me, she was yelling at me, "What did you do? Who did you sell my data to?" And she sent a scrolling screenshot from her phone that was like this long of all of the missed calls. So what it is, opt-out pre-screen is people can buy data from the credit bureaus to offer you a pre-screened offer of credit. So they're looking at your credit score and they can see some basic criteria that you would qualify. But when we pull your credit, that marks a mortgage inquiry. And now the bureaus get to sell the data of anyone who did not opt out pre-screen, and you will get anywhere from, like you said, 20, 30, 50, 100 calls in the current market. It will upset you. It will bother us. The people that you're going to be talking to are not vetted pros. They're children in a call center that don't know anything about loans, and they will aggressively sell to you. My favorite one is they will almost always lead with, "I can get you a much better deal." Well, I didn't tell you what my deal is. How would we know that you can get me a better deal? It just seems to be their standard pitch. So we actually here, someone just said, "How do we get the opt-out pre-screen?" And someone else was kind enough to comment here. Literally go to opt-out pre-screen online. And the thing that you should realize, some people, I don't think that any of us need more credit. If I need a credit card, I'm going to shop and figure out what card best fits my needs. But if you're the person that loves to go to the mailbox and see that you were offered another credit card, you will be opting out of those offers of credit. But it will keep you from getting blown up when you do have a mortgage inquiry when that time comes. So we covered that. There's a bunch of just little things here. JD, how do collection accounts and charge-offs enter into the situation for a VA loan? How does the VA loan program look at that? Do we need to pay them off? Is it determined by the automated underwriting? How does that work?
We don't necessarily need to pay them off, and it also depends on how long it's been. For a charge-off account, that means that the creditor is no longer pursuing the debt. So you really don't even need to worry about that because it's showing as a black mark on your credit already. It's already reflected in your score, and that creditor is already saying we are not going to follow up on this anymore, and so you don't need to pay that off. For collections, that's where it's a little bit tricky. I usually wait and find out what the automated underwriting says, and then after that it's underwriter discretion.
And really, for the most part, unless it's a very large collection, I haven't seen one. With four of us here, when was the last time you guys saw a collection need to be paid off unless it was something large and excessive? It's pretty rare, wouldn't you guys say?
Very, yeah.
So
now, I will say, because this comes up quite a bit, so there's two aspects that we look at with charge-offs and collections. The first one is qualifying, as JD just mentioned. Charge-offs we don't have to consider at all. Collections, case-by-case basis, but there's processes for that. The other aspect, though, is that even if we don't have to count it against you in your qualifying, it is affecting your credit score. And there are no exceptions for that. It will always affect your credit score if it's there. And so I don't know if we want to go super deep on credit repair tonight, but I'll just say this. If you do have a collection account or a charge-off account and you still owe money on it, speak with a credit repair specialist, speak with a credit comfortable lender. You do not want to pay anything until you've spoken with one of those experts, because there's certain language and certain agreements you can make with the credit collection agencies and departments and companies to actually get them to delete, remove, or at least try to improve your credit after you've made that payment. Once you make that payment, you lose your leverage. So if you are in that situation right now, talk to a credit repair expert first. Don't just go pay all your collections to improve your credit. There's better ways to do it. That's all I'll say.
Along those lines of improving your credit, Rylan, what do you think about Experian Boost? Is this a benefit to veterans? Is this something that they should be utilizing?
Yeah, I've had good success. It's not a magic wand that's going to fix everything, but it's free. You should absolutely go check out Experian Boost. You can upload on-time bills, so think of like Netflix, utility bills, cell phones, all these different things, and Experian will factor that into your overall score, and it could potentially improve your credit score. And I've had a couple clients get over those little bumps we were talking about, 720, and get a slightly better rate just by going to Experian Boost and knocking that out.
It's kind of unfortunate that the other two bureaus don't do it, because you need your Experian to be the mid or the low, and then it to boost enough to bring up that mid score. So it's a little bit of a pain in the butt in that regard. Mike, I asked you earlier about secured credit cards. Another thing that a lot of people do, especially younger folks, will go get added as an authorized user. Are authorized user accounts good? Is that going to improve credit scores? Can it make it hard? Can it make it worse for them in terms of qualifying?
It could do both, because it can improve your credit score, but if the account that you got added as an authorized user on is has a high credit to utilization, then it could bring your credit score down. So you would have to look at and make sure that the card you're getting authorized on is a good card, has a long history, and it's going to be good for your credit score.
One of the good things about it is if you do fall into that category where you're an authorized user and there's something negative there, either high utilization or, heaven forbid, I've had a client like I've never missed a payment. What are you talking about? Well, you're an authorized user on this person's card and they've missed several. The good news is you can get removed. That's like the only time when it's fairly easy to make the late payment disappear. You get removed as an authorized user, it no longer reports on you. So it cuts both ways, but authorized user cards can be a way to get you over thresholds if you have someone who has good credit and likes you a lot and wants to help you.
Just be careful But just be careful. I've had that happen once where someone said, yeah, I had him as an authorized user. Well, you had late payments and it was completely full.
Yeah, doesn't help us a whole heck of a lot when that's they're coming from the wrong angle there.
Real quickly on authorized user, if you are an 18-year-old, you just joined the service and you're trying to build your credit, if your parents add you to one of their cards in good standing, I've helped a couple young service members establish their credit by getting added as authorized users on their parents' card. So that's a good tactic too.
I will say I was super fortunate. I never didn't have a credit score because when I was like 14, my mom added me to one of her credit cards. I don't think maybe you can get them when you're underage, but she added me. By the time I was old enough, we went and pulled credit for a loan. I'm like, hey, look at that. I have a credit score. So it absolutely can be helpful for younger people. So we've talked about the credit score. Didn't a whole lot go into the debts and the actual monthly payments on the credit cards, auto loans, student loans, and things showing up on your credit report. But let's transition to the second part of the conversation here for tonight in terms of debt to income ratio. The VA loan is very unique in how this looks at this. So Rylan, I'll ask you the impossible question. What is the maximum debt to income ratio on a VA mortgage?
There isn't one. Trick question.
So
maximum DTI.
There is, like we've all seen it. It breaks somewhere, right? It's not written down. We don't know what it is. It's going to come down to on a manual underwriter's discretion, or when we run it through the automated underwrite, that the AUS is going to come back and tell us. So before we get into kind of the most important component of what's likely to get a high debt to income ratio approved, why don't we talk about sort of the difference between the automated and the manual underwrite and why that's important? So JD, you were saying you had a pretty high DTI on a manual underwrite here. Why don't you walk us through what the automated underwriting is, why the DTI can often go higher, and then how that compares to the manual underwrite that you just completed?
Sure, absolutely. So the automated underwriting system takes everything that we enter for the borrower. So it takes the income that we calculate for them. It takes all the assets. So I can tell it you have $10,000 in your checking account, you have $5,000 in your savings account, and potentially we even add how much they have in their TSP or 401k, because that helps with the reserve requirement or shows that you have more assets available. And then it also feeds in the credit report and goes into this little black box that calculates the odds and says, hey, you know what? This is a good credit risk. We'll lend on this. You have automated underwriting approval. The manual process is you have an underwriter going in, looking at every single factor one by one, looking at the accounts, and making a manual judgment on whether it's a good risk for their bank or not.
And with that, on both sides, one of the important calculations that they use, and the reason why the VA doesn't have a debt to income ratio, what they rely heavily on, the thing that it's not a written down maximum because it varies by property, location, family size, a million different things. They rely on what's called a residual income calculation. And what that says is after you've maxed out the DTI, do we have enough extra money left around to pay our bills and support our family? Mike, why don't you kind of go into detail as to what that looks like? As a loan officer, as an underwriter, how do they go about calculating residual income? What actually is that number?
There's a lot of things that actually go into it. So they take your income and they subtract out certain things. The size of the house, the location of the house has a certain number that they put in. What you paid in taxes is absolutely required to be put into the residual income calculation. And so you put the positives in, you put the negatives in. As long as it comes out positive, then you have a positive residual income. And that is the only thing that the VA requires, is you have a certain amount of residual income.
And so it's different than any other loan program, because even on the debt to income, we're talking about gross. How much
Mhm.
money does my W-2 show? How much does my tax return show I made? And in this situation, as you said, the first thing we do is take the taxes away and we go, how much money do you actually have? Not what does the paper say you made? What do you actually have? And then, like you said, where are you located? What's the size of the house? What's the size of the family? There's utilities that
It
vary
factors in
depending
maintenance
on
and
where you're in the
utilities.
country. Yeah. So when you look at that, I will say, go so far as say, we talk about here on the show a lot why it is essential that you work with someone that has extensive experience with VA loans. My favorite thing in doing cross qualifications for my realtors is getting a package over for a VA borrower. And when you look at the DU findings, it'll say that people have some spectacularly massive amount of residual income. And you're like, dude, you didn't look at the residual income. Most times it's okay, but it's not always okay. And if they don't know how to calculate it and they're not putting it in, we talk about automated underwriting. The big problem with garbage in, garbage out. I'm stunned when I see a DU that's correct, that the person doing the loan actually went through and did the calculation, because just 9 times out of 10, they don't. In terms of that, let's kind of talk a little bit about beyond the residual income. The residual income kind of answers the question for us as to why would the VA be okay with these really high debt to income ratios. When I say really high, I've never got one above 70%. Regularly hear from people here on the show. I think the highest it was a 67, 68, somewhere in that range. Rylan, did you said you had one higher than that here recently?
We just closed today, 70.12, and it's my highest ever. Before that, I was 68. Yeah, somewhere in there.
And as crazy as that is, I've heard people even higher. So when you hear that, you go, how is that possible? How can you put that percentage of your debt? So we talked a little bit about the piece of it that residual income tells that calculation of net income less expense factors for maintaining and having the utilities of your home and taking care of your family. It's telling the VA that there's enough income there. But above and beyond that, we were talking about this before the show. JD, would you say that most of your clients that have a really, really high debt to income ratio, there are things going on behind the scenes, that there is additional income that makes them comfortable with it?
Absolutely. Anything from we're not counting the spouse's income to they're receiving 100% disability, and they also are self-employed and they've been making money. However, they are deducting a lot of their expenses, so it does not reflect an accurate picture of what their true income is.
And with the one that I was talking about, mine VA loan, we can't have a non-spouse as a co-borrower. My guy was not married, but he had a girlfriend who made more money than him. So despite the fact that on paper it said it was a 67, 68 debt to income, when we add her income in, it was like a 31, 32%. So I don't want anyone watching at home saying these crazy mortgage people are trying to get people into foreclosures by giving these crazy high debt to income ratio loans. The VA loan gives us flexibility. Like everything else with the program, the VA doesn't want the veterans to get themselves into trouble. They don't want the VA to get in trouble guaranteeing these loans, but they also, wherever possible, want to see things in the veterans' favor. So if we can put it together, they have measurements that allow us to get you much further than any other program. So we've got a couple more good questions here. So first one here, can you discuss qualifying with a spouse who doesn't have great credit, but receives 100% disability has been employed for about 6 months? So Mike, if you have that situation, and if you're still here, give us a little info on doesn't have great credit. I talk to people and they say that, and the wife has a 632. I talk to people who say that and the wife has a 432. So tell us, if you're still here, pop in the comments what that actually looks like. But Mike, what advice would you have with him, or what would you be looking at in this situation?
So in this situation, I would look at, what does he have alone? What do they have together? What is her credit score actually? Just like you said, a lot of people think that a bad credit score is 632. And in 632, that would be a very doable loan for VA. So it really just depend. With her being employed for 6 months, we'd have to see what she did before. See a low credit score was 639. What I would do is put that in, see what it looks like, and then run some, see if we can get their credit bumped up a little bit. But What I like to do is, here's the scenario of what you do today with your credit score, what it is now. Here's what you can do to improve your credit score, and here's what it looks like. What would you like to do? Because this scenario right here, this would be an easy one where we say, you could go look for a home and we could look at fixing your credit, but this is what it looks like today. Is it important for you to buy a home right now? That is another situation too, where maybe they're PCSing, maybe they need to get out, maybe they need to move right now. That's important as well.
And this almost goes back to yet another situation. We talked about in my situation, the non-borrower was a girlfriend. We couldn't put her on the loan. We don't have to put your spouse on the loan. Community property state can complicate that a little bit, but this may be a situation where you have a 70% debt to income ratio on your own. We can still get you qualified and take that out of the equation entirely. With a 639, probably not a problem. But again, if we go back to that situation where it's a spouse with a 510, we absolutely may want to look at that. So the flexibility of the VA loan is really, really important in situations like this. And working with someone like Mike who can say, hey, you've got multiple options. Let's pencil them all out. Let's run them all through, see which ones will work for you. And then you just have a decision to make of what's going to be best. We've got another question here. My auto loan balance less than 3,000, paid off in approximately 10 months. FICO 8, average 785 with low debt to income, but I'm not a vet. Do I need to pay? I think they just hit pay it off. I think they just hit send a little bit early. So in this situation, not a veteran, so I think we're not talking about a VA loan, but either FHA or conventional. Would you guys advise a client here? It says already has a low debt to income ratio, high credit score. In most situations, we're going to be able to just ignore that entirely. It'll paid off in less than 10 months. Installment debt, so not revolving. We can't do that on a credit card and say, hey, it looks like it's going to be paid off in 10 months. But installment debt, less than 10, if it doesn't have a major adverse impact on your ability to make that payment, we're going to be able to ignore it. So definitely talk to your loan officer. I wouldn't do it preemptively. I'm sure you guys agree. I like to tell people, don't make any decisions until we've talked. Let's run through and pencil out all of the options and tell you the repercussions, and then you kind of pick which route you want to go. Is that pretty much what you guys are telling folks?
Yeah, and this is a good kind of back to our credit conversation. I have a lot of borrowers pay off their auto loans thinking that they're doing a good thing. They're reducing their debt before they qualify. And even if you're in the middle of qualifying, when you pay off an installment loan, like an auto loan or a personal loan, and that account closes, you lose all of that good credit history of on-time payments. Not completely, but I have seen people's scores go down after paying off a car loan. So even more so, if you think you might need to re-pull your credit before you buy, don't pay off the auto loan unnecessarily.
And again, all roads lead back to don't make any decisions until you talk to an expert who deals with this all day, every day, because a lot of things that are intuitive that you think I'm doing a good thing is going to put me in a better spot. It may or it may not. It may be a situation where the reserves in the bank, JD was talking about reserves on a file. The automated underwriting may prefer you have the reserves and have that debt that's going to be paid off in 6 months versus eliminating it. So I like to compare it to, we're laying all our cards on the table, and then we're going to figure out the best way to play that hand. So I told Shay we would answer her question, but I have a comment here. Jennifer Lego is a borrower, not a borrower of mine, but she was the moderator on a live stream that we do Wednesday nights for the better part of a couple of years. She bought about 16 months ago, and we haven't seen her since she became a homeowner. So she just wanted to stop in and say hello and say that she was watching the show here tonight. So Shay's question here is, how is DTI figured out for someone, say an E2 with a family? How does that work if they're trying to buy something with low wages? A lot of our veteran borrowers, active duty, taxable wages look really low. Rylan, you want to kind of walk through that of how sometimes those folks can get qualified for a property when the equivalent civilian out there with a similar taxable income is not going to have any hope of buying?
Yeah. So first and foremost, and My market is in Hawaii primarily, and for us, it's really like E4, E5 is probably similar to what you're asking with E2 in just the ability to qualify, right, based on the wages versus the house prices. And it's, I tell the guys the same thing. Make sure you're working with a lender that knows how to fully utilize all of your income. And it's easy to say that, but the VA loan, especially, we're looking at base pay, we're looking at your rations, your housing allowance. We can use your clothing allowance. It's not a lot, but every little bit helps, especially when you're, working on decimal points at a certain point. And make sure your loan officer knows that you qualify off the residual, not DTI, because that plays into a huge factor given, especially as an active duty service member, you have non-taxable income. So non-taxable income allows us to push that standard or traditional debt to income ratio even higher because the residual doesn't count against a DTI number. Conventional 50% DTI, we're hard stopped. Doesn't matter if you have a ton of non-taxable income left over, right? Residual is going to count taxes against you, but active duty, you have home of record. Maybe your home of record in a state that doesn't have state tax. That helps you out on your base pay calculations, and all of those other factors. Also, make sure if you get foreign language pay, if you get spec duty pay, anything that the lender can prove is going to continue for 3 more years, we can add in there. So no one's going to be able to magically increase your income, but making sure you're working with a professional that is familiar with VA loans and using everything that you do have, that just knowing you can use it is going to be huge. The other thing is your debt, especially when your wages are at that level. A car loan can be $500 nowadays, $800 a month. If you can refinance that car into your spouse's name, if they're not on the loan, that's something that we've utilized in the past. If you can refinance and consolidate, if you have a lot of debt and you can get those payments lower through a consolidation program, those are some options we've used. So those are a few things to try with, and maybe the other guys have some suggestions for you. And it is tough, but don't give up. Just keep working on it is my best suggestion.
And this is the part of the show where I repeat every week that it is important that you work with someone. It doesn't have to be a vetted pro, but you have to work with someone. If you are a veteran, buying, selling, getting a mortgage, you have to work with someone who has experience with the program. There are non-vetted VA pros out there that have that ability and that experience, but everything that we talk about, this isn't rocket science. It's not like, oh my goodness, you have to be a genius to know the things that Rylan just told us there. But you do have to have experience with the VA program, or you miss out on a dollar here, a dollar there, and the borrower doesn't qualify. You get pushed to a different program. We talked about it a lot on the show last week of how there are a lot of realtors and mortgage professionals that will say, oh, we can't get a VA offer approved. You need to go this route. And you can cost yourself tens of thousands over the life of the loan, the life of your home ownership. So if you need someone, if you don't have someone on the real estate or mortgage side that's experienced and you have that confidence in, you can go to vettedva.com, hit the map, find someone locally in your area that has been through the training, that has been proven to know and have this knowledge and information. Also would like to ask, if you're watching this on Facebook and you are not aware or you have not yet subscribed, go out to youtube.com/@vettedva. Like and subscribe there. We have a lot of content that shows up there. The video is much easier to find on YouTube than it is on Facebook. Lot of individual videos that you can search for that will go through just about any topic on the VA loan that you may need to know about, as well as the library of all the live streams we've been doing for almost a year and a half here now. So give you guys a last chance here. If you have a question, go ahead and throw it up. We'll be here for another 5-10 minutes. We like to keep these at about an hour. But before we wrap up, I always like to go around the horn, give everyone their last say on tonight's topic, credit scores and DTI, and also just any general advice to a veteran or non-veteran borrower out there, buying, selling, refinancing, any of that fun stuff. So JD, you got stuck on the top row here with me, so you get to go first.
All right. Well, I guess what I would say is don't self-diagnose yourself and think that you're not going to qualify. I've seen many cases where somebody thought they had really bad credit, ended up having close to 700 credit score, and we were able to actually increase that above that threshold in order to get them a better rate. There's also the possibility that even with a low score, depending on the situation, even if you had some late payments in the last 12 months, the situation warranted a second look from an underwriter, and we were able to get them approved. So my biggest takeaway is speak with someone that's going to take the time to look at your situation individually, and help you make a plan, whether it's for next week, next month, or next year.
Absolutely. Never too early to talk. I think speak for all three of you and just about everyone we've ever had on the show. It's not about, hey, you can only talk to a lender or a realtor when you're ready to buy or sell a house or finance a home. Talk to them whenever you need advice to find out exactly where you're at and what your options are. All right. We're up to you, Rylan.
Everything JD said was excellent, and I'm a parrot that don't self-diagnose. I have a great example of someone who thought they had a bad credit score, and we checked it, and they were above 730. So, speak with someone, get it checked out. And the other thing I was gonna say is get a second opinion if the lender you talk to says you can't do it, especially if they mention things like debt to income ratios being the reason you don't qualify, because every bank is different. And it is true that maybe that lender can't do it or the bank they work with can't do it. But the VA is a very flexible program, and it's a very common sense program. So if your situation makes sense, if you ran into some trouble with credit because of medical collections or things that happened in the past that you can explain why they're not going to happen in the future, those are cases that a loan officer can help build. And especially that manual approval is such a powerful tool. If we can tell the story to an underwriter and get them to see why you are a good credit risk moving forward and why buying a home makes sense, it helps to get a second opinion. Now, if the second opinion gives you the same answer as the first, at a certain point, it may just be the answer. But reach out, talk to people, and see who else is out there, because there a lot of people get told no, and maybe someone else could say yes.
Absolutely. Love that. Love the idea of definitely get a second opinion. If you think you're still getting the wrong information, maybe try for a third, but at least get two people to say they've looked at it and agree, and you can start to get some consensus that you have some work to do to get what you want. So with that, Mike, you get the final words tonight.
Start as soon as you can. It's better to know where you're at right now if you're even looking to purchase in a year. That way you can start planning on what you need to do so that when it comes to the point, you're ready to go. It's harder to do things when it's like, oh, I found this house, put an offer on it, but I don't have anything done. I haven't been pre-approved. It's harder to get that done rather than starting earlier. And then just make sure you tell your loan officer everything. I had one person that didn't tell me told me they didn't have to pay child support, and they actually did. That really affects your residual income and your DTI. So
It's amazing. Mike, would you say probably like once a year I get someone who thinks that they're helping by withholding the information, and then you have to play detective and try and get all of the info out of them?
Yeah, it's the underwriter will eventually find out, and then you're going to be put in a very hard situation. You've already got money on a house, you're getting close to closing, and now you're in the possibility of not being able to get the house. So let them know everything up front. It's better to start early and let them know everything.
1,000%. So again, appreciate you gentlemen being here, sharing your knowledge. Hopefully you guys can all see that credit wise, debt to income wise, it's as flexible, if not the most flexible program out there. You have access to folks who can help you wherever you are located around the country. Appreciate you joining us tonight. Next week, we will not be here. It's 4th of July. So hopefully everyone will be celebrating Independence Day and not wanting to know about mortgage and real estate. Hopefully some hot dogs and some fireworks and that fun stuff. But we'll be back in 2 weeks with a new set of experts. We're going to be talking about with the VA loan. The beauty of it is you do not have to make a down payment, but there can and will be closing costs. And we're going to go through everything you can expect to pay at closing and all the different ways that you can cover it. So again, appreciate you guys being here and watching. Appreciate you pros being here and sharing. We will see you guys in 2 weeks.